For decades, modern finance operated on the belief that the ancient problem of risk had finally been solved. Markets were unpredictable and investors were emotional, but new mathematical frameworks suggested these chaotic elements could be quantified. Risk could be converted into pure mathematics. This reliance on sophisticated models eventually created a massive collective blind spot. The mathematical certainty provided by these tools convinced the entire financial system to ignore the very vulnerabilities the models were meant to manage. At the center of this world was a mechanism called arbitrage. Because markets are not perfectly efficient, two assets with nearly identical economic value often trade at slightly different prices. An arbitrager identifies these temporary inconsistencies, buying the cheaper asset and selling the more expensive one until the prices converge. Arbitrage helps align market prices with economic reality, but for a typical investor, the opportunity is often too small to notice. These pricing differences are usually microscopic, yielding only a few $100s on $1 million trade. Generating meaningful wealth from such tiny discrepancies requires immense scale. To achieve this, investors use leverage, borrowing massive amounts of external capital to multiply the size of their positions. This is a simplified balance sheet, which tracks what a firm owns, its assets, against what it owes, its liabilities. The remaining value is the equity. When an institution relies heavily on leverage, their liabilities grow to a staggering size, vastly dwarfing their actual equity. This structure is inherently fragile. Because the debt is so large, even a microscopic drop in the value of the firm's total assets can wipe out its equity instantly. If assets fall by just 1 or 2%, the firm's net worth collapses. In 1994, a hedge fund was created to weaponize these mathematical principles on an unprecedented scale: long-term capital management. Its founders included elite Wall Street traders and a pair of Nobel Prize-winning economists. Their strategy was built on the observation that financial markets frequently overreact. While prices might temporarily diverge from their historical norms, the fund's model suggested they were mathematically guaranteed to eventually converge. LTCM convinced the world's largest banks that they had discovered a way to generate massive returns with almost no long-term risk. They had turned a sophisticated academic theory into a global trading machine. The strategy initially worked with remarkable precision. Flawless returns attracted more capital, which enabled more borrowing, which fueled even higher leverage. Success created a self-reinforcing loop of competence and growth. Beneath that success, a contradiction was forming. Because the strategy appeared so safe, lenders stopped strictly managing their exposure to the fund. Banks competed to provide LTCM capital on favorable terms, assuming the models accurately reflected reality. This created massive counterparty risk. Modern markets are interconnected networks. When banks lend to a hedge fund, their stability depends on its solvency. The scale became staggering. LTCM held $5 billion in capital, but controlled over $100 billion on its balance sheet. Major Wall Street institutions were blindly trusting the fund's academic models. They remained unaware of how fundamentally intertwined their own balance sheets had become with a single, highly leveraged entity. The shock arrived in 1998, when Russia defaulted on its sovereign debt. The default triggered human panic that overrode mathematical theory. Investors fled towards safe haven assets, ignoring the historical boundaries LTCM's models relied upon. This triggered a liquidity crisis. When every participant rushes to sell simultaneously, buyers disappear and the ability to trade evaporates. Prices no longer move according to logic. They move according to desperation. The historically linked assets in LTCM's portfolio suddenly decoupled. Instead of converging as the models predicted, they moved violently apart, causing the fund's equity to accumulate massive losses. As the fund's equity fell, panicked lenders issued margin calls. These are demands for immediate additional collateral to protect the lender from a borrower's potential insolvency. This created a devastating feedback loop. Falling prices triggered margin calls, which forced LTCM to sell assets into a falling market. Forced sales pushed prices even lower, triggering another wave of margin calls. LTCM faced a terminal distinction between solvency and liquidity. Their trades might have eventually become profitable in the distant future, but their inability to produce cash to meet immediate obligations meant they were going to collapse today. Regulators soon realized that LTCM's failure would be systemic. If the fund defaulted, every major bank on Wall Street would be forced to unwind the same identical positions at the same time, potentially freezing global credit markets. The Federal Reserve organized an unprecedented emergency rescue, bringing together the heads of major financial institutions to stabilize the fund. Crucially, the government avoided using taxpayer money. Instead, the Fed forced the private sector banks to recapitalize LTCM themselves, ensuring an orderly liquidation that the market could absorb. The Federal Reserve's objective was to preserve the underlying functionality of the financial system. Preventing a wider contagion in the global credit markets took precedence over the fate of LTCM's individual investors. The crisis proved that mathematical models are merely tools bound by historical assumptions. When correlations shift and human behavior takes over, those assumptions can break with devastating speed. While leverage can create economic efficiency, it inherently transforms future uncertainty into immediate vulnerability. The greater the leverage, the smaller the margin for error. These same mechanisms of extreme leverage and evaporating liquidity returned to fracture the system again in 2008. The details of the assets had changed, but the underlying structural fragility remained the same. The legacy of long-term capital management is a warning about the nature of systemic risk. The most existential threats to the financial system often emerge from the complex risks that highly intelligent people are absolutely certain they understand.